Major banks are illegally colluding with big hedge funds. Today I want to talk about how these big funds are so important that major banks are willing to not only manipulate the gold markets, but the stock market as well, just for their fat fees. But somewhere along the line they lost control, and this manipulation spiraled into a mess of over-leveraged hedge funds that are currently crashing the market and will cause the AMC squeeze. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, Bloomberg tweeted this article saying big hedge funds were so important to JP Morgan that its precious metals traders routinely manipulated gold and silver markets to get the best prices on client orders. The article says an ex-trader says JP Morgan spoofed gold to keep hedge funds happy. And he says client orders made a lot of money for the bank. Now this is really applicable to the stock market as well, as these giant hedge funds provide and pay massive fees to these major banks for their trades. Therefore, these major banks pump up the market, they short individual stocks, they create synthetic shares, they spoof orders and post fake trades, all for these hedge funds because of how important they actually are. These major banks realise without these big hedge funds, their fees, their income and their profits would drop massively. Therefore, they do anything these hedge funds want just to keep their money flowing in. Now, as I said, these major banks lost control of the manipulation, and what they've created is a mess of over-leveraged and over-risked hedge funds that are currently crashing the market. The article says big hedge funds like More Capital Management and Tudor Capital Corporation were so important to JP Morgan Chase that its precious metals traders routinely manipulated gold and silver markets to get the best prices on client orders. They brought in a huge volume of trading, which made the bank a lot of money and our team a lot of money as well. John Edmonds, a former trader, said they brought in a huge volume of trading, which made the bank a lot of money and our team a lot of money as well. And this is prosecutors allege that traders were influenced by the needs of hedge fund clients, whom at times were looking to buy or sell millions of dollars in gold or silver in a matter of seconds or minutes. And Edmonds said that when a client needed an order filled, everyone on the desk would stop trading so as not to get in the way of filling that order. Again, that just shows just how important these hedge funds actually are, because the bank would literally drop everything they're doing just to cater to this hedge fund. And that's why when these hedge funds asked for some manipulation or asked for something illegal, these major banks didn't bat an eyelid and fulfilled every request. And Edmonds said he'd regularly watch Nowak or Smith use spoof trades to fill those orders. So these major banks are using spoof trades or fake orders or potentially fake and synthetic shares as well, just to fill the orders of those hedge fund clients. So these major banks would spoof the market to push the price up or to push the price down to then execute a client order. So Edmonds started spoofing the market and pushing the price down, and minutes later their hedge fund client Smith sold 200 contracts, which is the equivalent to 1 million ounces, and subsequently cancelled his buy orders or cancelled the spoof orders. Now that article just shows these major banks are actually working together with the hedge funds to pump up the market, like the plunge protection team, and also to short individual stocks for these hedge funds so these major banks can generate additional fees. And to show an example of just how involved these major banks can be, I want to talk about this tweet from Darren Harper. So this article or this screenshot starts by talking about wholesalers called authorized participants. So authorized participants will at times intervene in the market if the trading volume of an individual stock or the market as a whole diverges too much from the IV value. If UVXY in this specific case, maybe it's AMC, maybe it's the S&P 500, if that stock is trading enough below the IV value, they start buying large blocks of the stock, which tends to drive the price up. This is practically perfectly describing the plunge protection team. When the market starts falling or starts crashing, the plunge protection team or these authorized participants step in and pump the market up. But you may ask, Tom, who are these authorized participants? And it says traditionally, authorized participants are large banks such as Bank of America, JP Morgan, Goldman Sachs, and Morgan Stanley. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to a total of $25,000 and a guaranteed free share of Lucid On top of that, Moomoo is also very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, Moomoo clear their trades themselves through their own clearing broker, Futu Incorporated, which does also not sell your order flow. Therefore, Moomoo is brilliant for buying those AMC shares. So these major banks like Bank of America and JP Morgan are being these authorized participants and purposefully pumping the market up or bringing it down specifically for these hedge funds. And specifically in the case of ETFs, when there is a shortage of ETF shares in the market, authorized participants create more shares. So therefore, it seems these major banks or these authorized participants also have the ability to create synthetic shares, obviously, for these major hedge funds or these big hedge funds. And I think this really describes the relationship between these major banks and these big hedge funds working together for both of their benefits. These major banks get additional fees and they get a ton of these additional fees. These hedge funds get the market shorted synthetically or illegally, and they benefit massively on their trades as well. But as I said, what's happened is this manipulation has spiraled out of control, and these hedge funds are massively over-leveraged, massively overexposed, and massively over-risked. These hedge funds are currently on the end of bad trades that they can't unwind because of just how many synthetic shares have been created. They are losing money and they are about to go bankrupt. And obviously when the crash happens, these risky, overexposed and over-leveraged hedge funds will be the first to end up going under and the first to be liquidated. And I think this tweet from David Stewart also perfectly explains it. He said AMC people are asking how much longer before we reach the mother of all short squeezes. He said the answer can't be given direct in the number of days, months, years, hours, weeks, or anything other. The mother of all short squeezes will happen as soon as these short hedge funds are liquidated. And he said that's happening relatively soon as these short hedge funds are massively over-risked, massively overexposed, and massively over-leveraged to the market that is currently crashing. Gold Telegraph also tweeted saying breaking news. Chinese authorities held an emergency meeting with banks after growing alarm that an increased number of home buyers across the country are refusing to pay their mortgages. Now you may remember there's been a massive bank run on a number of these banks in China. Customers aren't allowed access to their money, and therefore these Chinese citizens simply can't pay their mortgages because they don't have access to their bank accounts. But obviously because these mortgages aren't being paid, a number of home building companies are very, very concerned, and now so are the Chinese authorities. Gold Telegraph followed up by saying reports of rapidly escalating refusals to pay mortgages in recent days have sparked losses in Chinese bank shares and developer bonds. And they've said this reflects concerns that the nation's property crisis may spread to the financial system. So we're already now starting to see the Chinese property contagion already reaching over to the Chinese financial system. And again, I do think this contagion will spread further into the US financial system and the US property market as well. Clearly these Chinese property companies and these Chinese banks are struggling significantly as millions of homeowners are refusing and simply can't pay their mortgages. Now I also wanted to touch on the crypto market and also the default and bankruptcy of Celsius. Bennett Tomlin tweeted saying, all day I've been hearing that Celsius has a $1.19 billion hole on their balance sheet. Their liabilities exceed their assets by $1.19 billion. And then he's pulled the numbers, and that asset value is assuming their CEL token is worth $600 million and that their mining assets are worth $720 million as well. So the CEL token currently has a market cap of only $240 million, and if they dumped all of that token, they'd likely only receive, say, 50 million. Therefore, their deficit or their hole is much closer to, say, 1.5 billion, and they likely also don't hold $720 million worth of mining assets. Celsius Network recently announced their Chapter 11 bankruptcy as they have $5.5 billion in liabilities that they owe to customers and to creditors, and only $4.3 billion, more like $3.3 billion, in assets. On top of that, the NFT platform OpenSea has also announced a mass layoff of 20% of their staff. Back in January, OpenSea had a valuation of somewhere around $13 billion. This has likely fallen by say 80% by now and is likely only sub $5 or sub $4 billion now. Back then they had 90 employees. They have increased their headcount, but they're now cutting 20% of their workforce due to the current crypto and stock market crash. It's crazy to see these massive crypto companies like OpenSea, like BlockFi, like Voyager, like Celsius really struggling and going bankrupt day after day after day. And as I said, this is only going to add to the current crypto crash and spread across to the current stock market crash as well. I do think as we get closer to the next FOMC meeting and the next interest rate hike, the stock market will continue falling, and I also expect the crypto market to continue falling as well. I think if Bitcoin falls below $18,000 again, and if the stock market dips and sets new recent lows, we will see tons more hedge funds being liquidated and tons more giant crypto exchanges going under as well. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.